This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. Today I'm going to say that we went on a factor rant, but everyone's going to be thinking, well, isn't that every episode?
No. This week was about a paper you published recently that talks about the rationale for factors leading up to the model portfolio for DIYs. And I suggested it be its own paper because I think how you set it up in the paper was so well done. So you got pretty fired up about it. It was good.
Yeah, I did get fired up. And it was a long episode, so hopefully you guys listened to it. But if you want to hear us talk about factors, it was probably after 30 minutes that we started talking about the paper.
Yeah, and we covered off stuff from the budget. I mean, that's where we took a bit of a detour as well, talking about one of the things for retirement planning, which we thought was interesting. We could have perhaps made that the feature.
Yeah, we probably could have cut this up into 2, even 3 episodes, but
we're learning.
There's lots of
40 episodes.
There should be lots of good stuff in there.
And love the comments and the feedback we've been getting. Thanks very much.
Yeah, it's true, actually. We've had some really nice reviews, new reviews on iTunes, and a bunch of people rated the podcast. I mentioned that last time, and I don't know if that's what drove people to do it. It seems like more and more people are listening, and I know I said this last time, but it just creates really good dialogue because I probably get at least 3 emails a week from people who are listening to the podcast and they have a question or a comment. And that's really engaging, and it helps us continue to produce good content on the podcast. So like I asked last time, if you're enjoying the podcast, rating it's awesome. But if you have one person that you can share it with that you also think would enjoy the podcast, that would be awesome. From what I understand, podcasts tend to grow organically.
Anyways, have a listen.
That's it. Welcome to episode 40 of the Rational Reminder Podcast.
Nice round number, 40. Anyways, this week we're going to kick it off with a quick update of a hedge fund that I mentioned. I was pitched on the podcast 2 weeks ago, so I went back and did a bit of homework on that. And then we'll talk about some pieces from the federal budget that we think might be of interest. And then a little bit of data we found on, factor performance. But the main thing we want to talk about, since we're talking about a main theme every other week, is a paper that you just released last Friday, I believe.
One of the top downloaded resources from the PWL Reds website right now, which is good. People are reading it, but we'll talk a little bit about that as our main topic for today's episode. But before we get there, let's hear more about this hedge fund, Cameron.
Well, it's kind of a story from the front. This was back in, I'm guessing I was pitched this fund in 2007. So it's a fund that was launched in 2003. It's called Sellers Capital. And we were pitched on Mark Sellers of Sellers Capital. It was a fund with a 2 and 20 fee. So it's 2% plus 20% of the profits over whatever the high water mark is. I couldn't find that information. But the returns had been so great up to the point we were pitched. It was basically a no-brainer, and you owed it to your clients to use this fund. And then the person that was recommending it to us would split the 10% performance bonus for us.
But talk about the investment philosophy of this thing.
It's crazy. But let me back up on the comp. So it was about the comp. So if you're going to make 50%, if the fund make 50%, you're making 20% of that 50, right? So there's 10% that's paid, and he was going to split it 50-50. So I was going to get 5% of all the money, theoretically, if it grew at 50% a year. So we were talking, if it had kept up, serious dollars. So it was a real commission push that was being pitched to us. So at the service, this is at lunch, right? So you say, okay, we'll look at it, but I just knew in the back of my mind we would never consider it. So here's the philosophy. Small cap companies selling at or near tangible liquidation value. Okay. Hold a very concentrated portfolio and make big bets. This is on the correspondence of the fund. We don't diversify. We don't think volatility is risk. We like volatility. It's amazing. They spend nearly all of their time figuring out the likelihood of permanent capital impairment. But get this, the fund was owning a company called Contango Oil, which was trading around $3. They started buying it in 2003. By the summer of 2008, the stock had risen to $92.
So he really did kill it with his stock.
High conviction. So I couldn't find all the numbers, but I remember that it was well over 50% of the portfolio was in Contango Oil at that time. And I remember saying, as I mentioned in the last podcast, what if you're wrong? And the person didn't even know what I meant by, what do you mean, what if I'm wrong? Couldn't even imagine you could have been wrong.
And then he was wrong.
then he was very wrong. So in October 2008, the manager retired and said that he hated the hedge fund business. Here's the quote. "What I've learned about the hedge fund business is that I hate it," says Mr. Sellers, a former stock analyst at Morningstar. "I have enough money that I don't have to work, and why should I put myself under this much stress?"
Pretty brutal thing to say after just losing his clients a whole bunch of money.
So I think I found one article that said it was up to 1.4 billion in contango oil. That's one of the filings I found.
Wow.
So the portfolio, I can't imagine it. So it must have made up like 2/3 of the portfolio. I couldn't find that data, but the point is it's a massive bet, which is what he said he was going to do. And he delivered. I can only imagine at 2 and 20, he would have made an absolute fortune. So of course he didn't have to work again. Anyways, currently he's the CEO of a company called Barfly Ventures, which owns a number of student bars and restaurants in the US. Long out of the business.
Interesting pivot. So that kind of ties in with another article that you sent to me just on the discussion of luck versus skill. Like obviously this guy had Sellers Capital had high conviction and he had the intention of placing concentrated bets on individual stocks, and that paid off.
Bet big. Yep.
And then people went and sold that good past performance. But that raises that question that we always have of if someone does well, were they lucky or were they skilled? And there was an article that MarketWatch had about a trader in the US that turned $100,000 into $2.5 million on a single trade. I can't remember what the trade was. I read about it, but it was whatever. The guy created a thesis, made a big bet on it with options, and won. So Barry Ritholt wrote about that story. Barry said that if you see great past results like that, you have to ask 4 questions. Are the results statistically significant? Was the trade the result of luck or skill? What is the long-term track record of the approach? And is it repeatable?
Which are all very logical, normal questions that you and I automatically would go to that. But as human beings, we're pattern seekers. We want to believe that this is skill.
Of course we do. Yeah. So I thought it'd be good to go through each of those questions and just kind of put some data around them. But for the first one, is it statistically significant?
I love this stuff.
To be statistically significant, an active manager would have to generate 2% annual alpha, so 2% excess return in excess of the risk taken per year, with a 6% standard deviation of alpha, so pretty tight. Like in most years, you're beating the market or beating your benchmark. It would take 36 years of that. So 36 years of 2% alpha with a 6% standard deviation of alpha to have a statistically significant evidence of skill at a 95% level of confidence.
And think about that, 36 years. So someone starts and they're 24, you have to wait till they're 60 and go find a 24-year-old manager of a portfolio. So we've been there a while, I guess, for Warren Buffett, but how many others? And
you go and find that 60-year-old manager who's just had that alpha for that period of time, and they're probably not going to be managing money for much longer. They're probably going to retire, which is one of the other challenges with active management, is that if you do have a truly skilled manager, your success is tied to that human. And humans are obviously unpredictable for all sorts of reasons. Eugene Fama and Ken French did a paper in 2010, and this is answering one of Barry's other questions. Was it the success the result of luck or skill? So Fama and French looked at U.S. mutual funds. They had a ton of data. And what they found was few funds produce benchmark adjusted expected returns sufficient to cover their costs.
And didn't they find even fewer than they would have expected by luck?
Not 100% sure on that.
I seem to recall, because I was at a presentation that Ken French delivered in Toronto when that paper came out. And I seem to recall him saying that.
Interesting.
It's probably due to the costs.
Yeah. Well, so they talk about that. When you add back costs, they did find evidence of both inferior and superior performance, or what they would call non-zero true alpha, in the extreme tails. So there were some really good in terms of skilled managers and some really bad managers, but only when you add costs back in. So after costs, I guess another way to think about that is that the active managers, even the skilled ones, were not skilled enough to generate excess returns after costs.
Yeah, and especially if you look at where a lot of managers have a lot of freedom is in the hedge fund world, which typically have the 2 and 20 type compensation structure.
The point of that bit of data is that when it's been examined with mutual fund data, which is the easiest data to analyze just because it has all the public disclosure requirements, the evidence of skill is very bad. not strong. So one of Barry's other questions was, is there a long-term track record to the approach? This one's interesting, really interesting, because you can always find some fund or strategy that has done really well over the long term.
Again, it's just chance. You have enough managers, someone's going to have great performance.
So I think it's not just looking at the long-term track record. It's looking at the long-term track record and then asking the question of why, which I guess ties into Barry's other questions. Is it repeatable?
And I can remember back in the 90s, we talked about the fund industry 2 weeks ago. Companies would launch all these different funds. The ones that didn't do well, they just go out and kill them and let the good ones survive.
Still happening. The the Standard & Poor's SPIVA report for mid-year 2018 showed 10-year survivorship for mutual funds in Canada of about 50%.
So it's not even getting better.
No. Well, survivorship isn't. So anyway, whenever you see, and I think, I get the sense that people who listen to our podcast understand this, but whenever you see a person or a fund or whatever it may be with really strong returns, even if they seem smart, you've always got to ask those questions before concluding that what they've done can be repeated by you or by anyone else.
Show me the data.
Yeah. And you had a quote from Annie Duke. She said the quality of the outcome doesn't tell you about the quality of the decision-making. Exactly. Which is pretty good. So you see someone that has had some great returns, it doesn't mean that they made a good decision. They may well have just been lucky.
A bad outcome doesn't mean a bad decision.
Well, yeah, we talked about this a couple of weeks ago with rational decision-making. If you make a rational decision, there's still a non-zero chance that you're going to get a bad outcome.
Exactly.
But that doesn't mean it was a bad decision.
So it was budget week a couple of weeks ago. A couple of big takeaways that we noticed. One is, and this one I find interesting, it looks like these swap-based ETFs are on their way out. And this is something you had talked about in a discussion group that we were in preparing for an article that just came out in Money Sense.
I would sometimes wonder why, I wouldn't wonder, I would question why are we not using the swap-based ETFs? And when you start going through it, even after the drawbacks, which is stuff like, well, they don't have access to small cap because, I'm not going to get into why, but they generally don't have access to small cap in the swap-based structure. So that's a drawback. But even with that, if you're in a personal account with a high marginal tax rate or a corporate account, the tax benefits far outweigh any lack of diversification. So it's like, okay, well, why would we not use them? But the answer that we've always come to, and the reason that we were not and are not using them for clients, is the legislative risk. And we used to always say that, and I'd run the numbers on it too. And what I found was that if you ended up having to realize the gain on one of those holdings, like for example, for HXDM, which was the developed international markets swap-based ETF, you would have to hold that for at least 5 years to make it such that you wouldn't have been better off holding a regular long only ETF for a long period of time. So it's like if you had to realize the gain on HXDM in year 2, you would have had higher after-tax returns after 30 years of holding XEF.
So what does this mean, practically speaking? If the legislation does go through, it'll be triggering a capital gain for unrealized gains so far, or just on growth going forward?
I don't know.
But Horizon did say in a press release that they expect that their funds in a list that they had would be impacted by the changes after their 2019 taxation years.
Yeah, they said the funds listed in the table below, which included all of their swap-based funds. But it's just interesting to see that the legislative risk, which is something that we had based a decision on because we hadn't used the funds, due in large part to that risk.
Yep.
But in a lot of cases, I wouldn't say I was skeptical, but it's a risk that's really hard to know how sensible it is to base a decision on. And a lot of people online would say, well, no, they're never going to get rid of the structure. So I'd question it. but then
less than a week later,
then it happened. And we just released a YouTube video on the same topic. And again, there was actually someone who commented on the YouTube video saying, well, you're way overstating the legislative risk. Like that's never going to happen. And then it was like 2 days later, the budget came out and it did happen.
But really, it makes sense to take it away. You're not that surprised.
No, I'm not surprised. And this is something that I've been cautioning people of as long as I've known that the structure existed. And I think Justin's written about this in the past too. I think a couple of years ago, he even wrote a post saying that he just said that he wouldn't be surprised if this went away.
So what do you make of the new Advanced Life Deferred Annuity, or ALDA, that was mentioned?
Yeah.
So this is kind of longevity insurance?
Well, it's of course it is. It's an annuity.
But anyone could do that at any time. So what it is, they're allowing you when you retire that you're going to be able to push 25% of your RRSP forward to at the latest age 85 to buy a deferred annuity, so a cash flow like a pension that will start later, the most you can push forward is $150,000. But the annuity was always an option.
This lets you defer the income.
Defer the income off the annuity. So therefore, it could reduce your RIF. It will reduce your RIF payments earlier on, which could help you keep your OAS.
If you have a large RSP and a long life expectancy, then I think this becomes a pretty interesting planning tool. I think that annuities they're probably underutilized now. And I think that as people continue living longer and longer, they're going to become more and more interesting from a planning perspective. This budget item, it's effectively a way to defer. Well, it is. It's a way to defer your RIF minimums or reduce your RIF minimums and defer income using an annuity.
Right.
So I don't think it's not a reason to buy annuities, but if you're going to buy an annuity anyway, this is potentially a really interesting way to approach it.
Mind you, the numbers aren't that huge, but it takes pressure off worrying about providing income when you are later in life.
Yeah. If you don't have capacity to make decisions, it becomes extremely interesting.
But I've sat with a number of people who wanted to do an annuity and it came down to doing the paperwork and they couldn't write the check because the money is gone. And literally they're in the boardroom and they couldn't do it.
Yeah.
We'd done all the proposals, all the paperwork, and they could not do it. Now, the flip side, we've done a number of annuities back when rates were higher and they're so happy now. One example where she wrote the annuity when, it's got to be 20 plus years ago. And it just keeps on paying. And this is back, I think the rate was 8 or 9% on the annuity. And it was a prescribed annuity, so not too much of the income was taxable. So it worked out incredible for her.
Yeah, like I said, I think that annuities have been underutilized by the profession in general. It is an insurance product, but I think it feels like an insurance product, and people are generally skeptical of insurance products. But as people live longer and longer, I think that it'll be sensible for people in our position who are giving advice to start having a little bit more conviction about annuities and when they make sense and why they make sense. But it's all about, we ran the numbers on this a while ago. It's kind of like when you use the Monte Carlo approach to financial planning, which is what we do. The end result is that you have to plan on average to die with a big chunk of money in order to not run out of money spending from a portfolio that has variable returns.
Especially the younger you are.
Right. So when you take that Monte Carlo approach, it ends up being what a lot of financial planning researchers would call inefficient spending, because you're not spending all of your money. You're ending up with this big pool of capital left that you didn't spend before you died, but you had to plan to have that so that you wouldn't run out of money before you died.
Because you didn't know the path of returns.
Correct. And annuities take that away. So you're exchanging your risk, I guess, or you're exchanging the capital to eliminate the risk of a sequence of returns, I guess.
But you're taking on more inflation risk, are you not?
Well, you're taking on inflation risk. That is true. But you're making longevity risk go away. I haven't spent too much time looking at annuity products. Do we not have inflation adjusted annuities?
Then you really give up on cash flow though. And there's the cap, I think there's a cap maximum 2% inflation on I think that's one of the rules I read. But it'll be neat to run some of the plans in our software to see what it does due to the success rates.
Well, so this is the thing. If your goal is to guarantee an amount of income, it will cost you less to do that with an annuity, at least based on the last time I ran the numbers, than it would with a portfolio. So if that's the only goal, is I want to guarantee $1,000 a month, it's going to cost you less to buy an annuity to guarantee that than it would be to invest in the market.
Because of the variability of returns.
So right.
And when that variability happens.
So it's going to cost you less, but your next generation, so if you have kids or a charity that you want to benefit or whatever it is, they're going to get nothing if you bought the annuity. Whereas with the portfolio, they have the chance of getting something. But for you as an individual wanting to guarantee an income, it's less expensive to do that with an annuity than it is to do with a portfolio. You just give up the upside.
It's also a huge peace of mind. I mean, the few people we have that do have annuities, they don't worry about it. The pension just comes in. The check just shows up.
Anyway, so we've gone off on a bit of an annuity tangent, but I think that was a really interesting item in the budget, was the advanced life deferred annuity. A couple other things that were in there, like they're increasing the home buyer's plan amount. That's small, but worth mentioning maybe. And there was the piece about CMHC sort of subsidizing down payments for first-time home buyers. That was an interesting little piece as well. I was talking to a friend of mine who's in real estate, and he thinks that is going to push up the price of homes at the lower end because now people can afford a larger down payment. People who qualify for this supplement who would have been buying a less expensive home can now afford to pay more for that. So it could have interesting implications on Canadian real estate, but obviously who knows?
So you want to talk a bit about that paper that Dimensional put out this week?
Yeah, it was interesting. The timing of it was interesting just in relation to the paper that we put out. And I'm just thinking about it now, but I think that I'd probably talk to Brad about the data in the paper that he put out, which may have inspired me to write the paper that I put out. And maybe that's why they were similar.
Yeah, I think there was a conversation around that, but there's some pretty neat data points in there. I mean, the one that really got me was it showed how the sample timing you use to look at past performance can change so fast. You remember that chart that showed the Russell 1000 growth, so large cap US stocks, but the growth part of the index beat value for every single time period from 1 to 20 years, or 1 to 10, then 15 and 20 years as of March 31st, 2000. So over every past period from 1 to 20 years, growth beat value.
So for the period ending March 31st,
2000. So I think that's going through the 90s. That's a big growth tech boom in the US. Advance that time period 1 year and look back over the same 1 to 20 year time frames. Value beat growth over every single period. So the whole table turned upside down over a matter of a year.
It's unreal.
That's how bad growth did in that year. It dragged the whole thing down. It's unreal.
And well, it feels, I mean, I was not paying attention during the tech boom in the 2000s and the 90s, but the period that we're going through now, I don't feel like it's the same. I don't know. You'd know better than me.
It doesn't feel the same at all.
But we have seen a handful of tech companies grow their stock prices in an extreme way, which is what is making value look bad. Growth
what's
has just
different
been
now is not everyone is talking about it. Back then, everybody was talking about it. Cab drivers, people were firing us because we weren't getting the 15, 20, 30, 40% that their friends were getting. Everybody was buying Nortel and Entrust and JDS back then, mortgaging their house, price goes down, take out bigger mortgage. That's not happening now.
Interesting.
And this was rampant back then. Anyway, so you put out this great new paper. I love this paper. It's called Factor Investing with ETFs.
Wait, I want to talk one more thing about the paper that Dimensional
I thought you were going to link this in. Anyways.
Well, they kind of tie together, but this is one data point that was not in my paper that was in the Dimensional paper, and I thought it was a really interesting data point to talk about. So they looked at 4 factors. So the market factor, size, value, and profitability over 10-year periods. And they looked at over 10-year periods, in what percent of the time was at least one factor premium negative. So in 50%, this is going back to 1963 for US data. In 50% of 10-year periods, going back to 1963.
So 10-year periods, January to January. So all the rolling 10s, right?
Rolling 10s, yeah. So 50% of the time, or just under 50% of the time, at least one premium was negative. So over 10-year periods, at least market size, value, or profitability, one of them was negative.
For the 10 years.
Yeah. So half the time you're going to have at least one of the factors underperforming. But then they looked at how many instances were 2 of the premiums negative. Only 8% of the time. So that's like over 10 years, you've got the market and also small caps with a negative premium. 8% of the time. 3 premiums being negative, 0.2% of the time. So that's market, size, and value, for example, all have a negative premium over a 10-year period. That's almost happening.
It's not combined, it's individually.
Correct, individually. And then all 4 premiums, so market, size, value, and profitability, having a negative premium. So that means, it may be worth just talking about what that means. That means T-bills beat market. That's a negative premium for the market factor. Large stocks beat small stocks. That's a negative premium for the size factor. So for all 4 premiums, that happened 0% of the time over 10-year periods going back to 1963. So I think one of the buzzwords that gets thrown around these days in marketing of funds is multi-factor. Like everyone wants to get a multi-factor fund. Well, I don't know if everybody wants that, but everyone's trying to sell it. There is some validity to the idea of having multiple risk factors in a portfolio. And that's the reason why. Because they're not going to perform the same way at the same time.
I agree. I mean, the data is pretty powerful. And this doesn't mean negative returns. So small minus big can be negative, but the returns can still be positive. It's the difference between those two.
That's
Right?
exactly
So
correct.
small could be 6 and big could be 8. That's a negative premium. They're both positive returns.
That's right.
So it's the relationship between the two.
It's the same thing for you. Market is the same thing. Market could be positive, but if it trails T-bills, that's a negative premium for the market factor. All right. So like we mentioned at the top of the show, the paper that we put out on factor investing with ETFs, it seems like people are reading it, which I think is really neat, because I think it's information that has sort of gotten lost just in the discussion on minimizing costs and maximizing simplicity. And I know we talk about factors all the time, but I think that this paper gave something really tangible for people to think about, because it's an actual ETF portfolio, or it talks about an actual ETF portfolio that you could implement.
Yeah, I mean, I try to make the case that this is really 2 papers in one, but you decided to keep it all together. I think the first part does a great job of explaining the benefits of the factors, some historical data.
So I think we have to talk about and this is kind of what I wanted to talk about for this piece of the show today. We talk about factors all the time, and I know we've had the comment that we've never really explained what they are. And I know we said we'd explain it to my mom eventually, which we will do. She'll be in Ottawa in the next few months, so it'll be easier to schedule that. But we will still have that show for anyone who's wondering. But anyway, I still think that even without my mom here, we can try and talk a little bit about a little bit more about factors at a level that is going to give, I think, people more context to understand why we get so excited about it. Any discussion on factor investing has got to start with the capital asset pricing model, which was the first factor model. And it just looked at the market factor. But I think my favorite way to think about the CAPM is that it gave us a framework to compare the performance of 2 portfolios. Now, one of those portfolios might be a benchmark. The other one might be an actively managed fund. As an example, it lets us control for the amount of market risk that each of those portfolios is taking. So if 2 portfolios have the same level of exposure to the market risk factor, which is known as market beta in the capital asset pricing model, if they have the same exposure to market risk, but one of them has higher returns, that return difference is called alpha. That's positive excess risk-adjusted returns.
Yep.
So if you can take the same amount of risk and get higher returns, obviously that's great. And that's what active managers try to sell. And before the CAPM, before we had that ability to relate 2 portfolios based on the amount of risk they were taking, there was no way to know. Like, how did you even evaluate how a manager was doing? So that's great. And the market factor was the first factor that gave us that framework to compare portfolios based on risk taken. The problem with the CAPM was that it only explained about 2/3 of the difference in returns between those 2 portfolios.
Oh, that's right. This is about portfolios.
Portfolios, securities, whatever you
theory.
want.
This goes back to Markowitz and the CRISP database. So finally, they had data going back to 1926 where you could start doing this kind of research into security prices.
Right. And this is all based on markets being efficient. The whole CAPM is based on markets being efficient. So anyway, the CAPM explained about 2/3 of the return difference. So what that means is if we had those 2 portfolios with the same amount of market risk, but one of them had higher returns, there was 2/3 of that was explained of the return difference was explained by market risk. 1/3 was unexplained.
So you set the academics off to try to figure this out. That's effectively what will happen.
Which they did. So in 1981, Rolf Bonds came out with his paper, which was, that was actually the paper that came out around the same time that David Booth was implementing the first small cap fund for Dimensional. I think their fund launched before the paper came out.
And remember, we talked about that, I don't know, a month or 2 ago. And that fund was launched not because of CAPM, but just because of diversification.
Right.
Managers are all managing large cap stocks. How about some small cap just for diversification? It was not based on what Bonds found out.
But then Bonds' paper came out around the same time, and they were like, "Oh wow, we can. This is actually kind of cool."
And then they went 10 years with small cap underperformance.
So anyway, the reason that Bonds' research was important was that he showed through the CAPM framework, he showed that small stocks had consistently higher risk-adjusted returns than would be expected by their market beta. So if we only have one factor to evaluate returns, which is market beta, if we only have that one factor and we look at small cap stocks, they look like they are producing alpha.
Right.
They have higher average returns than would be expected by their exposure to market risk. So that was an anomaly. That was like, okay, well, geez, maybe markets aren't efficient after all because they're mispricing small cap stocks.
And they weren't behaving like the market.
So then not long after, in 1985, some other guys, Bar Rosenberg, Kenneth Reed, Ronald Landstein, found similar results for value stocks. So again, they found that value stocks were producing higher returns than would be expected based on their exposure to market beta. And at this point, keep in mind, we still have the single factor CAPM model. That's the only way that we can evaluate the differences in returns relative to the amount of risk taken.
This is like 7 years ahead of the famous Fama-French
Correct.
three-factor model came out. This is long before.
So Rosenberg, Reed, and Landstein, their paper was actually titled Persuasive Evidence of Market Inefficiency, which is interesting. And bonds too, like both of those papers were showing, okay, we've got this CAPM framework and security prices and returns should be related to risk. But then these two papers come out and say, yeah, no, doesn't work. CAPM does not work, or markets aren't efficient, either one. So then in 1992, that's when Fama-French came out with their paper. And obviously Fama had already proposed the efficient market hypothesis. So he came out in 1992 and said, no, these anomalies aren't proving that markets are not efficient. We just need to adjust our risk factor model. We can't just look at returns through a single factor market beta model. We have to add in the specific risk, the independent risk of small cap stocks and the independent risk of value stocks to the model.
Exactly.
If it's going to be meaningful.
As a comparative tool for other management, other portfolios.
Right.
Because even if just by owning small caps will explain part of your portfolio returns. So you have to take that factor into account.
That's right.
As opposed to the market factor.
Right.
Because remember, this is a tool to help measure other managers, explain performance of portfolios.
How much risk did you take? And what was your return relative to that risk?
Exactly.
So instead of looking at that question through the market factor, just the market risk lens, Fama-French said, we need to look at this through the lens of risk taken from the market, risk taken from small cap stocks, which are independent. They have an independent risk, and the risk taken through exposure to value stocks. So when they introduced their three-factor model, all of a sudden the small cap and the value were no longer anomalies. They no longer had, well, they still had higher returns than would be expected by their market beta, but they did not have higher returns than would be expected by their exposure to the small cap factor and the value factor. So this was a breakthrough at the time. It reinvigorated the idea that markets are efficient. We just needed to take into account these specific risks in the model. So with the three-factor model, the explanatory power, so the ability to explain the difference in returns between two diversified portfolios based on the risk taken, increased from about 2/3 of the difference with the CAPM to about 90% of the difference with the three-factor model. So it's a big deal. And keep in mind that the reason we really care about this is, as investors, it's neat that we have better explanatory power over the differences in returns. But the reason that we really care about this is that the differences in returns between small cap stocks and large cap stocks has been positive.
So let's talk about those differences.
Yeah. Well, we can maybe just gloss over that. Since then, so since 1992, there have been two other sort of, I guess you'd call them breakthroughs from the efficient market perspective in asset pricing. And that was in 2012 and 2013, which is when the profitability factor and the investment factor respectively were discovered in air quotes, proposed, whatever you want to call it, written about. And Eugene Fama and Ken French took those two new factors and tacked them on to their original three. And so now we have the five-factor model. And with the five-factor model, we can consistently explain the differences in returns between diversified portfolios to the extent of about 96% of the difference. So pretty much all of the difference in returns between diversified portfolios can now be explained by their exposure to these factors.
Talk about incredibly liberating. And when I learned this years ago, it's just, wow, it just takes a whole pile of cognitive overhead away. You don't have to worry about manager selection anymore.
Right.
Because this will explain it. Every time I think you've ever done it, it always comes back to the factors explain the return.
Oh, yeah. If you take an active manager that has beaten the market, well, who did that? Mark Carhart did that in 1997, I think. And this was with a different four-factor model that included the Fama-French three factors plus momentum as the fourth factor, which Fama-French did not include in their five-factor model. So
to tie the prior two stories together, to be able to pick Mark Sellers, you'd be able to see if there's any one of these factors explaining his returns, but then to know that it's reliable, he has to have done it for 36 years. To have something as robust as this framework.
But he's also got so much security-specific risk that it would even be hard to look at it through.
So a manager, I'm just being facetious, but in general, you'd be able to explain the returns by this framework, but then to know that he has alpha he will have to have had to do it for 36 years.
Right.
To have confidence in that decision to pick him over this model.
Yes. And his alpha, you're right. So that alpha gets smaller the more factors we add to the factor model. Because remember that alpha is risk-adjusted returns, like traditionally, alpha is excess risk-adjusted returns through the single factor CAPM lens. But as soon as you start adding on more factors, a lot of that alpha starts to be explained by the risk taken.
Right.
So anyway, the reason that we care about this stuff so much on our side for Cameron and I, and the reason we get so excited about it is because I get excited about factors.
Really? I don't think people can notice.
Do I need to slow down?
No, keep going. This is good.
Take a breath. I think that just the fact that that the factors explain the differences in returns between portfolios consistently, that's evidence that they're a real thing. Like these aren't just made up things. They consistently explain.
And you think about the rigor that went on for years behind the scenes to get to this point, to build that crisp database going back decades, to do the research, to have peer reviews of your research to get to this point. And they say, nah, we're not going to use this. We're going to go pick this manager. I
don't get it either.
I don't get it.
No, I've said this a couple of times and I haven't actually gotten to the point. But the reason we get excited, about this stuff, or one of the reasons, is that when you start looking at the factor premiums, so how much excess return have each of the factors delivered over the long term, they're really meaningful. I mean, you look at the market factor, which that's just the market. You get that with a regular total market index fund. In the US, going back to 1926, it has had a premium in excess of T-bills of 6.28% per year on average. And again, in the US, going back to 1963, market premium has been 5.09%. And I'm going to stay with 1963 here because we have data for all 5 factors.
So everybody gets that. I mean, that's part of the revolution towards broad-based index funds.
You get that. Just with
S&P 500, the Morgan Stanley World Index.
Yep.
That's what you're getting, the market.
Getting the market. Now, SMB, so small minus big, the premium that small stocks have delivered over big stocks in the US going back to 1963 is 2.35%. And that's meaningful.
Very.
And then HML, so that's high minus low, that's cheap stocks minus expensive stocks. Premium has been 3.48% per year on average, going back to 1963. RMW, which is robust minus weak, that's firms with robust profitability minus firms with weak profitability, 2.84% per year on average. And CMA, even though it's not targeted, like Dimensional does not target CMA in portfolios, our ETF model portfolios don't have exposure to CMA, at least not statistically significant exposure.
So what is CMA?
Conservative minus aggressive. So this is firms that invest conservatively minus firms that invest aggressively. And I, to be honest, don't fully understand why, but it's not, it's a weaker relationship. And I think based on that, nobody's really using it in portfolios. It definitely helps to explain differences in returns, but the premium's not as interesting. And that could be an issue with implementation, like how do you actually define investment? I'm not sure. Anyway, CMA has had a meaningfully positive premium as well.
So these are all U.S. factors. So when the paper first came out in 92, they were criticized, I believe, for only having U.S. data. So they went back and dug up the research. I think Jim Davis was a big part of doing that research to go back and see if it worked out of sample.
Yeah. So then we have global ex-US, which is the out of sample. And market's been less positive than the US, 2.31%. Small minus big, 1.02%. HML, high minus low, 4.29%. Robust minus weak, 4.06%. But these are big numbers. I mean, global ex-US, HML and RMW are larger than the market premium. And that's just one piece of it. So the other thing that we hear a lot of the time is, well, the factors aren't guaranteed and they might not show up for long periods of time. So in our paper, I looked at that because it's true. Like the factors aren't always going to show up and there will be extended periods of time like we have now.
But that is always the criticism of these factors. What if they don't show up? I saw a tweet today talking about now that we've gone a decade where value has underperformed in the US, it's because that so many people are onto this factor, they've arbitraged it all away, which I don't think is true. We got many periods where it...
Well, you can't. I mean, first of all, when we're talking about factors the way that we are, risk factors that explain the differences in returns between diversified portfolios, you cannot arbitrage that away. That is not a thing. It is a risk that you are taking.
Right.
I think that, and we've talked with us on the podcast before, when you're talking about behavioral factors, that could sensibly be arbitraged away. Now, I know that there are limits to arbitrage, and that's what a person arguing for a behavioral factor will say. But anyway, I want to talk about persistence of the factors. So if we look at the market in the US for 10-year rolling periods, so that's again 10 years and then shift 1 month forward, the 10 years, shift 1 month forward, 10 years. So going back to 1963 for the US, the market premium, so that's the market in excess of T-bills, has been positive 80% of the time. Small minus big has been positive 73% of the time. High minus low, so value in the US, has been positive 89% of the time.
So more than market.
And same for RMW, robust minus weak profitability, 86% of the time.
More than market.
So in the US data, going back to 1963, over 10-year periods, the premium for value stocks and profitable stocks, or stocks with robust profitability, have been positive more often than the market premium. So for someone to say, well, the factors, yeah, that's all good and stuff, but what if it doesn't show up for 10 years? That's valid. But the same thing is true for market. The market premium may not show up for 10 years. And historically, there have been more periods where the market hasn't shown up than value hasn't shown up or profitability hasn't shown up.
If you believe in factors, you got to believe the whole way.
You can't believe in the market factor. If you believe in market cap weighted index funds, you have to believe in the size premium and the value premium. It's all based on market efficiency. It's all based on the market pricing in risk. You think what is the price of a stock? At the end of the day, the price of a stock is the discounted, it's the present value of future cash flows discounted at some rate. And that discount rate depends on the amount of risk that the stock has exposure to. And that is the basis of, that's the basis of valuation theory. That's the basis of prices. And if you believe that all that stuff is accurate, which it is in an efficient market, or at least most of the time it is, you have to believe in all the factors. You can't just pick one and say, I believe in market or I believe in value.
And the greater the risk the buyer of the stock perceives, the cheaper the price will be because they're commanding a higher return for taking that investment.
Exactly. So there's information in prices. That's the whole idea of market efficiency. Anyway, this episode's getting kind of long, but you know what? I'm kind of okay with it.
But we've got to get to the great table, the great chart you've got.
Yeah. So the point of the chart, and you know what? This was kind of covered off in the paper that we talked about that Dimensional just did. But the chart in the paper, it's on page 9 if anyone's reading along. Yeah, if you're reading along, that's pretty neat.
To me, this is what seals the deal for me. You can see graphically, it shows 10-year rolling numbers of the factors, and it's incredible how differently they perform over 10 years at the same time.
But it's like the data that we talked about from the Dimensional paper. You pick one factor and find a time where it was negative, and the other factors were not negative.
Look at the past 10 years, like right now.
Value's negative.
Value's negative.
Size is actually positive.
Positive, and market is very positive.
Very positive.
Very positive.
When you look at past periods where market was relatively negative over long periods of time, this is over 10 years.
The period ending 2009, way negative on the market, but way positive on value.
And size.
HML and size.
But the point is, we're going through this period now where size has been so-so, value's been negative in the US. Market's been amazing. So people are saying, well, the factors are not going to pay off, they're uncertain and all this kind of stuff. But we're in this one little tiny sample of time where at least value is not paid off, but that has happened before for the market. It's happened before for small caps, and it's happened before for the market more often than it's happened for value. We could go on about the data in the paper forever, but I guess you guys can read the paper. I
think next time we can talk about the securities that you've chosen for the model portfolio.
We kind of talked about that. We talked about that in a past episode, but yeah, we can talk about it again.
I think that's a good summary. I think it's great information. It's put together. It's very readable, very straightforward. I think you've done a great job outlining this, the rationale and the science behind these portfolios.
All right. So I think that's
good for this week.
That's it for this episode.